Hi, everyone, and good afternoon from here, and good morning, good evening, where you're also joining from. Once again, I say a very big welcome to every one of us. Welcome to another session of our mentorship program, and I trust we've all been having fun, and we are also enjoying this session and what we've covered so far. Please, if you have any question, as I said, remember, you You can always ask. You can always ask. You can always ask. I'm giving us permission to omit our mic. Now, I'm sure you'll be wondering. Some of you might be thinking, okay, since this is taking longer than you would have expected. So just to remind you, from onset, I said it was not a training, right? It's a mentorship program. So which means why this is going on, you're expected to also use this opportunity to do self-learning, right? Do self-learning on your own, which is the main key thing. We're just using this as a case study, right? So as something to also use in the live session as our own learning point. So it's not a training, right? This might be like an ongoing thing, but your own ability to do self-learning is what will make you stand out. So once again, a very big welcome to everyone. If you have any question regarding our last activity, I got some of you submission and I was not impressed, right? Attention to details. Okay, so I think we have a question now. Okay, question. I noticed you use just the total SG&A to calculate the payable, but shouldn't we also consider including some cost of sales in the payable? For instance, as we make bread, we might be owing the flour supplier some money, the direct production costs, and this is okay. That I think that's a very good point. So if I come to my calculations, that's a very good point. Now under our revenue, we calculated that for trade receivables. I think that's a bit clearer, right? Then under cost of sales, we calculated our inventories. Okay. And then for our payable, so if we have inventory, we're also supposed to have trade payables. So what did I use for our trade payables? Oh, okay, that's a very good point. So for our trade and other payables, now because we are putting it together, both the trade and the other payable. So that is a very good point. We ought to also consider our cost of sales as part of the trade and other payable. So that's a very good one. So I think I can just add this. So add cost incurred. I'll just add this my total SG&A plus my what plus my cost of my total cost of sales, right? Which is also in positive. So total cost of sales, and that kind of give us a true, clearer picture. That's a very good point. As I said, see that's why learning is very important. Now, so some of you that were able to detect the error, right? I think we use wrong. So trade payables. I think the trade payables is properly linked to the correct one. Let me check the other one. So for our inventories, yes, linked to the correct one. Then our receivables is linked to this one. Okay, so yeah. So in your calculation of payable, you use inventory days to calculate and not payable days. Was this intentional? Okay, let me check again. So our payable days, we are saying 30 days. Is that what we have? Yeah, so I'm not sure where you guys are saying, or am I missing something again? So your calculation of pay, you use inventory days to calculate and not payable days. I just recheck that now. Okay, the formula. Oh, okay. Oh, okay. Very, very good. I think I love that. Perfect. So see, this is just to tell you guys that one, uh, even we that we build model at the highest level, right? When we are done with the model build, we still have another team that their homework is to make sure that they review everything thoroughly. So no one is above mistake when it comes to modeling. Is part of the model build, right? And as I said, it's garbage in, garbage out. So Good point, and thanks to people that observe that. So you can see the reason why it is not just a model. Do you know that this ordinary simple error that I made? Now look at this. So let's say this is the error that I made, right? And this is what to have been this is the value that I was supposed to have. Now, when it comes to valuation, this is a very big blow because this can move a business valuation from a 5 million discussion to 7 million discussion. So it is part of the model build, and that's why I usually tell you guys that, see, as a modeler, attention to detail. You can make mistakes. See, it is allowed. It is part of it. And that's why you always need to take time to do a lot of self-review. So to people that got this, well done to you guys. It shows a very good learning point. As I said, you need to do like a lot of self-learning. I remember, right, the company that I'm working with now, when I had my practical interview, it was a different type of financial model interview I've ever had. You know what it was all about? Should I tell you guys, or you guys are not interested? So what what they did was they shared a model, right? The model is full of different errors. Now, there were calculation errors, there were linking errors. So the model contained almost 10, 15 errors, and they kind of fall under different segments. So there are one that are related to more like typical accounting double entry error, right? The balance sheet was not balanced. There were calculations error, there were linking errors. Then there were more like analytical part of it, right? The analysis part of it. So, for example, something like this, which you guys observe, can be considered as one formula error, right? And then can also be considered as more like a business error. So, for example, a business that you do not expect them to have each receivable days, and you by the time you see the balance sheet, you are seeing every receivable outstanding balance in their balance sheet. It kind of tell you something that no, this is more like a business error. And as a modeler, those are kind of things that make you stand out, because it gets to a point you move away from the artistical part of it, building into model and you need to move into the mechanical aspect of it, which is part of what we are going to cover today. So as I said, yeah, if you think we are spending much time on this, see, mentorship don't usually end. It is not a training, right? But the whole thing is, as we are making progress, you're also making progress, right? You are learning different aspect of it and you can apply it. Now, a very good example. We both agreed when we started the model build that, oh, let's go with positive and negative convention approach of model build, which means things we are deducting, we should put them in negative value. Okay. Now, some people submitted their own activity. And let me give you one good example, because I saw this more than 5 people. Now, you've stated less cost of sales. We've agreed. I think, did we create our model sales style guide? Okay. Okay, so what I usually do is when I'm building my model, I usually state the sign conversion if everything is in positive, right? Or if anything we are deducting are in negative. I always state that as well. Now, you see something like this. This is where you, as a modeler, this is where your business understanding comes into play. So today we might just have like a short discussion, short talk. As I said, it's not a training, right? It's a mentorship. Now, you look at cost of sales, and let's look at some basic accounting rules. Okay, allow you guys I left you guys mic open, and I think maybe I should just mute it again because some people just be might leave their mic up. So let me disable it. So I think maybe when we want to talk, we can. Okay. So maybe when you want to talk, you can just raise your hand and I will allow you to talk. Okay. All right. So now you look at something like this. Basic, there are some basic things. So by the time you are done with your model, when we build and at least on the eye level, there's something we call check, right? Check alone, you can have almost 100 check in your model build. And it's to help you check something. So now, one, let's check at least using our basic accounting knowledge. Basic accounting knowledge. Let me ask you, within sales and gross profit, what check can we create? So let me hear from you guys. So let's make use of the chat box, right? At least, what error do you think we can make between our sales, cost of sales, and gross profit? Do you think what kind of error do you think we can make there, and we can build like a check around it? So now today we might not spend much time, but the business understanding, right, is what I need you to pick out from our session today and see. Even if you see millions of people that can build models, right? There are some things that just make you stand out. Like, okay, you need to think like the way management think, which is the mechanical aspect of it. So let me hear from you guys. Think, 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 think. What are the kind of checks do you think we can create for us to see? So as I said, some people just make some funny mistake, right? Instead of putting this in negative, they put it in profit, in positive, and they are still adding this together. You've already defined our concept of accounting already. You've defined the concept of business operations. Because basically what you are doing here now is you are overstating gross profits. Some people even went ahead as putting operating expenses in positive, and they had that confidence to even share their model with me. No, that's not the kind of modeler we are building. So firstly, right, think. The first thing is you can have some key ratios, but let's even look at, let me leave the key ratio. So I'm going to call this guy checks. Okay, so now the first check is this. When you are building your model, number one is gross profit, right, greater than sales? That's the first thing. Sorry, is cost of sales, so COS, cost of sales, is cost of sales greater than, should we say greater than, or okay, is it lesser than my sales? That's the first thing. Then the next one is gross profit, is my gross profit, right, also lesser than my sales? Okay, so now let me put this. So equal to, the first one is I'm saying, so let me put let me see. Okay, so yes, so if, right, so absolute, which is a Excel formula that just make sure everything is in positive. If, so we are saying is cost of sales, so cost of sales, which is this guy, so the ABS just help me put this in positive, right? Are you lesser than my sales? Comma, you should give us so maybe we can, let's use like 1. So if it is lesser than, you should make it 0, and if it's not, you should make it 1, right? So let me do that again. Now equal to if what? If my, so I need this in absolute so that they are always being positive value, right? Are you lesser than my sales? Comma, if it is true, it should give me 0. If not, it should give me 1. Close my brackets, and here I can now use my formatting, right? My formatting syntax can update this. So if it is 1, right, which is positive, it should give me, so open a double quote. If it is 1, it should give me error. So negative can never be negative, so we only need one as a, so semicolon. Then the next one, which will be 0, then should give me okay, and click my okay. So that just kind of appear like this, right? If it is, let me see, let me just try and tamper with this, and let me see. Okay, yeah, so that gives us error. So you can also use conditional formatting to be sure that whenever it is okay, all right, maybe let me just do that. So conditional formatting, and highlight rules. If it's equal to 0, right? What should happen? I just need a, let me see, custom. Then I need the font to just be something like blue, no border, no fill, no color. So click OK and OK, right? Then I can still highlight it the same thing again and say highlight if it is equal to 1, which is the error, should just make it red text. Click on OK. So to be sure it is working, just try and invert the formula. Right, it should give, okay, perfect. So it's working. Yeah. So this help you to keep track. That's one, cost of sales. Then the second one, as well, so I can just copy this formula and put it here. So equal to if my gross profit, right? So I also need the gross profit to return absolute, because it can be a loss as well, right? If it is lesser than my revenue, it should give me 0. If not, it should make it 1, since I've already formatted it. So what this will do is to help you keep up this check. And I can even just, so you can have like a master check by the side here. So which is the summation of this guy, right? So for example, people that made mistake, right? Instead of putting this in negative, you put this in plus. Look at what happened. So this just throw up error. So you throw up that error, and it help you to keep track of what is going on in your model. So you have like a master check that you build when you are done with the model. But things like this are very, very important to make sure that you keep your model in check. And put this back. Let me put this back. So you can create those checks to help you keep track of your model build. Most time when we create like a model template, right, we make sure we create all these type of checks, so that by the time the user is inputting data, right, we make sure that they are putting the correct thing and able to also check if everything is okay. All right, do we have any question regarding that? Another thing that can also help is our KPI, right? KPI, so key performance indicator. Some people are so KPI, or the same thing as ratio, right? And you can have your revenue growth, right? Gross profit margin. So you can have your SG and A to revenue. You can have your cost of sales margin, right? Cost of sales margin. You can have your operating. I think we have you can have your EBITDA margin. EBITDA margin. You can have your operating margin, and any other ratio that you want to add. So this also help you to check So operating net profit margin. So things like this just help to keep track of what you are doing. Now, as I said, we are not just trying to be an artistical modeler, right? That just put everything in Excel and you leave it like that. Now, if we take a look at this closely, what's your observation? So let's take a look at from our sales down to EBITDA. So remember I said we have line item we call top line. We have line item that we call core business operations, right? So from sales to gross profits, that's the top line. From sales down to EBITDA, that's what we call the what? The core business operation. Now, before we go ahead building other parts, let's first look at this business from the angle of EBITDA. Now, I really want us to have like open discussion. As I say, we might not even do much today, but you see that discussion part of understanding business, how business transform into figures. We usually say that, see, irrespective of the decision the business is making, irrespective of the strategy they are trying to adopt, if it is not translating into figures, if the impact cannot be seen in figures, then definitely it is not making much sense, right? And I know there are some entities that try to check how each staff contributes to the business bottom line, right? So I'm going to let's have that discussion now. What do you think is happening in this business? Looking from the sales to EBITDA, you are the one building the model. As I said, as a modeler, you're not just a modeler, you are also an advisor. Now, what do you think is happening? What do you think this business can do better in order to maintain a profitability? Because remember, you are building this model for them to use and get like investments. And I'm sure that you don't want to build a model and they will send it to an investors and you are seeing everything red. So now let's now have that discussion. If you want to, if you prefer to open up your mic, yeah, you can do that. If you prefer to chat, let's have that discussion. I think I would love today to be more of a proper discussion and business understanding. So if you prefer to talk, you can just raise your hand and I'll give you the permission. So let's have that discussion because I expect you guys to have seen this as you were building that model. So you don't need to wait till the end, right? As you are building, you can see, and that's why I said build one line item, link it directly. Build this another line item, link it directly, and as you are building it, you can make sense of it. Those are more like what we call even self-checking. Because if you actually did that, you will not put cost of, you will not see that your gross profit is even higher than your sales, and you think your model is okay, and you can still share that. Okay, right? All right. So we are spending more than we are producing. I love that. It's as simple as that. It's as simple as that, right? We are spending more than we are producing, and that is the story of every businesses. Okay, so the company can try to reduce their forecast of the OPEX and cost of sales. Where while I hear about the OPEX, do you think they have control over the cost of sales? Because if they don't buy those raw material, they can't sell. That's story of manufacturing businesses. Okay, so the company revenue is low, but the cost and expenses are on the high side. I agree with you. I agree with you. Right? Now, which is number one. You can see that the cost on the high side, even by default, if it's like this, your number one advice is, you know what, you should not just go on with this business. Don't just bother. Okay, so the salary currently outweigh the revenue. I love that. Comparing the scale of the business to the staff list, the human resources is too much and probably underutilized. I love that. I love that, right? So, yeah, I agree with you. Cost of sales is fairly moderate. They need to streamline the OPEX. And that's the importance of financial model, right? As what people you think that, oh, is it not just for you to plug something in Excel and you are good? No, it's way beyond that. But as I said, even model is part of the visibility, and that's why most times when they are trying to do this visibility, they first have the first model, and they will tell you, you know what, just give us the model at high level of a thing, right? Then after that, by the time they are sure that okay, this is looking a bit realistic and viable, they now go down into building the whole model completely. So these are how you you use model to make decision. It's not just an artistical thing. Management use it, right? I remember then company I was working with then. I remember there was a period, that period we had really low sales, right? We were not getting that much job. And my manager was the owner of the business was keen on employing staffs. And we had to ask that was this man, what's going on? Even we that we are here, we are not certain, we are not even sure of this salary we are collecting, why we are not getting jobs and the whole thing. But you know what? He said he's confident because he understood the seasonality of his business. He knows when things are on the low side and when things will, will be what on the high side. And he has built that model in such a way that he's sure that okay, if we can maintain this minimum income inflow, right? This cost, those minimum inflow can absorb the what? The expenses, right? And that's the usefulness of building model. So by default, we know here that what the business, any operating expenses cannot go beyond this gross profit. And this is more like because the gross profit, as I said, revenue first umbrella, cost of sales because they are unavoidable expenses. You have your then the gross profit becomes the what? The next umbrella. Right? It becomes the next umbrella. So immediately we see this, the next thing is what can we do? What can we do? And now this is where you as a good modeler, your skill also comes into play. One is you know where everything is in your data. You know what is driving what and what is not driving what. So majorly, if you come to my calculation and I check my total SG&A. Now, some people also did another mistake, right? We said selling general and admin expenses. You can have a breakdown of different line items, but please always remember to create like a summarized table that we pull everything together, right? I saw someone that, see, let me show you what the person did. So the person only went ahead and linked to this total operating expenses and they left out the salary expenses, which is the main huge cost. Now, this person will send this and they'll be like, oh, this is good, this is looking good and the thing. But you know what? There's already a business error. Because when you look at this, you'll be like, wait a minute. Yes, let's even assume the business is high in variable costs. This operating expenses is way too low. So once you see that, it should call your attention to something. That is the mechanical skill you just need to build. And that will prompt you to go back and check. You can look at the difference from 426 to 71,000. You can see that difference. You can see that gap. So please, attention to detail is very, very key is very, very important. So make sure you just put them together in a summarized table like this, so that you can have everything grouped together and you can link the total. Okay, so now salary is the main problem and is the main driver here. Okay, and now let's go back to the input and let's look at what can we do, regarding the human resources, both the head count and what, and the pay per head. Right, so now we are doing this together, so you can try to do that. You can, so let's do like a simulation. So one thing I usually like to do is, if I'm trying to see the impact of changes in my input to my output. So for example, I can just do like, so this is my I can call this HR cost, right? I'll just link this from my calculations, and so that can just can help to see how I'm changing things and how that affects on the output. So for example, if I say, oh, sales personnel, right, we really need that three, but let me hear from you guys. Let me hear from you guys. Now, this pay per head, considering we are not in the economy, right? We are not in that particular country. We also need to reevaluate and check if the salary schedule has been given by clients themselves. You remember, this is our own case study. The client did not give us the pay per staff, right? If it has been supplied directly by the client, please don't just go ahead and make those changes or updates. You need to let the client know. For example, like, oh, this is a draft model, right? This is what the impact of this pay. So you need to state it clearly so that the clients don't just go ahead and start altering client data. The way you have this data, right? The way you have the output. So you might not want to share the whole model with them, but try to let them see the impact. And if there's a way to reduce any of the cost. So now let's see manager. So maybe let's put manager to 3,000, right? Single reduction in manager, put the cost from 355 to what? Change this to 3,000. So this just want to be sure. Maybe they need to find a way to manage their costs, or if there's a way to increase revenue. If there's a way to increase revenue. Okay. So reduce manager, sales personnel, maybe we should also reduce that to 2,000. Right? Accountants, maybe put that to 2,500. Then admin staff, maybe 1,500. Security, other staff. Right? What's the impact? The impact is still on the high side. Okay, come back to my inputs. Which other one? So maybe 2 sales personnel, factory staff. I'm sure those, we definitely need those ones. We need the admin staff and the rest. Okay. So now with this, it's still on the high side. Now, there are some businesses that you just need that personnel capacity, because if not, it might be difficult to drive your business growth. So if really there's nothing we can do here, then that means we might need to go back to our top line and see what we can do. Okay, so now you see that you are working as a financial advisor. You are thinking the same way management will think about managing their businesses. right? Then if they no other option than to, they can say that, "Oh, you know what, we cannot even increase the top line," then maybe they allow some staff to go and just start thinking about outsourcing some of what they do in order to manage costs. And that is the reality of businesses. Okay, so if we come back to our revenue, let's check our forecast quantity. Okay, so maybe if that's the case, maybe the business might want to try and do what? And do try and increase their scale a bit. Here, our capacity is 15,000. And let me check our revenue calculation. Did the business use up the revenue capacity? Okay, no, they did not. Okay, so maybe let's say white bread, maybe they might need to even have to increase their capacity, also ask for more money, right, in order to be able to achieve a large production and something like that. So let me add 500 to each of our quantity, or let me even say 1,000. So let me add like 1,000 to it. Then for our capacity, let me increase our capacity to maybe like 18,000. Come back to my revenue. Let's see what is happening. Let's see what is happening. So this is the reason why it is called model, right? It allows you to do what? To check different changes and how they impact what? Output, right? So you can see increase in revenue is also what? Increase in cost. But the more you sell, right, it also kind of increase the gross profit margin to cover up the expenses. Now, with what we've done, and also we also need to look at the growth. I'm sure that the growth is realistic, is reasonable enough. I think the answer is yes, right? Because in advanced country, you don't usually see those kind of uh, revenue growing, unrealistic revenue growth. Now, it seems we still have no other option than to go back to our operating expenses and find a way to still reduce this cost. Because one is it looks as if we've stretched out our the sales, right? By doing what? By increasing the capacity by increase the capacity by at least 3,000, then increase our forecast units monthly by 1,000 units. So which other thing do you think we can do? Let me hear from you guys. Yours, I'm sure you have your own version, so you can also try to do that, simulate those changes, and let's see what you get. So obviously, we are left with nothing other to go back to our operating this uh, salary expenses, which we still need to find a way to see what we can reduce. So let me hear from you guys. So let me hear from you guys. And these salary expenses, what I think do you think we can do? And this is the beautiful part of modeling. This is what we actually do. We don't just know about just pull the figure. Even if the clients they've given you, you are working as advisor to them, right? And that's why you also have like different cases where you case one, you keep the client data the way it is. Uh, then the another scenario is where you kind of impute adjustments, right, that will make the business profitable a bit, and that can just give them a room to still think, okay, so the manager salary can be cut down significantly, assuming they are the owner of the business. Very good. So which is the question that we now need to ask. This manager, will he be like, will he be the main, will he still be the same owner, or they are going to get someone that will do what, that will be in charge, right? If you can guess question, if you cannot get that, factory staff, I even think factory staff, do you think we can reduce that? You need guys in the factory to help with the production and the whole thing. So let's check. Let's check. So let me even reduce our sales personnel maybe to 1.5. So we're going to get two. My accountants to maybe 2,000 as well. Right. Admin staff as well. So maybe 1,000. Let's look at the impact. Okay, it's still looking more like it. All right. So why do we have two admin staff? That's true. But yeah, you can have two admin staff, you know. But maybe okay, maybe we should put it as one, right? One. What's the impact? Okay, very good. So you can see now that we are getting to this profitability stage, right? So don't worry. Let's say manager maybe 2.5 again. See, so that's why you can say that management they can go into meet. So when you have a model like this, especially if you are dealing with a what we call a working capital model, where clients have they have the real model, right? And they use it to track their day-to-day activity. Uh, you go into management meeting, see, it can take like this, they can spend days just sitting with the using the model. Say, oh, you know, okay, can we do this? Do you think we can bring in a new personnel here? Do you think this can our revenue absorb that? Can this happen? Can that happen? So those kind of things for we okay. So someone said, can we reduce the security? We even need the securities. It's more like an advanced country, but maybe let's just, you know what, let's just put like 500 for the security, right? There's nothing for it, other stuff. Put that as 500, so you can see what that impact look like, right? So this is, and that's just the beauty of model. That's the beauty of model. So it's not just the artistical parts, and that's why you also need to give attention to detail. Know what you are doing when you are building that model. Okay, so EBITDA, what other adjustments can we do? Or the adjustment, if you also go straight into our operating expenses, right? Our logistic of 1,200 USD. Do you think we can find a way to reduce that on a monthly basis? 1, 2. So if we decide to make this 800, that reduction alone, let's see what the impact will be to become profitable from year 3 onward. Right. So these are more like the business analytical skill that you need to develop to tell a good story about, okay, you know what, this is about this business. When you look at the output, you can tell. You can, there are some people that see they they are not good at building model from scratch. But if you finish up your model and you give it to them, right, they can tell you so many things are wrong in your model. They can read just looking at the financial outputs, they can tell. So one is from the income statement, another one is from the balance sheet, another one is from the cash flow. And it's easy to tell. Okay. So is there any other thing we think we can adjust? Any other thing? Any other thing? Okay. Can we further push the production capacity of the Huawei? Okay. So a very good one. So as I said, see, it's all about that, and that's the way management think. It's not, that's why I used to tell people, it's not just about the figures we put in this workbook. No, it's way beyond that. It's all about decision making right now. So someone is saying, okay, you know what, can we push the capacity of the white bread while we leave the multigrain as this, since white bread is more profitable than the other one? Very good point. Okay, you know what, even just let's add 500, so maybe a 7,000. to that and see, I think this is looking good, right? So there are different things you just need to consider as you are building the model, right? Ask, check, look through the model, right? Don't just make it garbage in, garbage out. If it is that kind of modeler you want to be, um, so it will be a long way for you, right? To cope when you get to the real world of model B, because it's now way beyond the artistical part. Now we've sorted the first part, which is the EBITDA. Now, because the business will be getting loan, definitely there will be an expectation of some ratios that will also need to be considered, which is the next phase of what we are doing. And after that, then we also look at the cash as well. So as much as we are making this adjustment, by the time we get to the cash, uh, right, we're done with the model builder and we look at the cash, and the cash is looking unrealistic. That is when another adjustment will now come into play. So it's like a phase kind of thing. Firstly, we've said that, okay, yes, I think this is good. So let's say first year, so because of some operating expenses and maybe low revenue kind of thing, first year, in fact, 2 years can also, year two can be negative, right? We've built models such that the first 4 years were negative. What we had to do is to just extend the forecast period to be able to say that, okay, you know what, considering the nature of the business and high operating expenses, that project, we could not reduce the operating expenses, because it's just the truth of the matter. But yeah, it might take them some time to be able to get to the revenue that can give them that profit, but they can't do with those expenses, because it's we also drive drive that revenue target that they want to achieve. Okay, now let's go to the next one. The next one, which will be our what? Which will be our asset calculation, right? So we've done our sales, cost of sales, operating expenses. Then the next thing is our depreciation and amortization. Now, for us to get our depreciation and amortization, we need to calculate our what? Our non-current assets, which is our property, plants, and equipment. Now, let me ask us, should we go ahead and do it now, or we should call it a session here today? What do you guys think? I think we should even do it like that. So you guys go ahead and you try to build the schedule. No, I think you guys should do it. You try and build the schedule on your own, at least based on what we've learned so far. We've done some activity where you had to build an asset schedule. All right, so let's see. Okay, so operating expenses. So the next thing will be our assets. So our non-current assets, right? So let me call this non-current current assets. Okay, so now before we can get our non-current assets, we need to reevaluate our funding and our use of fund, right? So now let's recategorize our. So firstly, I'm going to call this our use of funds, so which we need to summarize. So the first category, we have the pre-operational expenses, right? Let me see the best way for us to put this. Okay, so I think we should just put it like this. So pre-operational expenses, we're going to call it pre-operational expenses, right? Then the second one will be our capital expenditure. Then the third one will be our let's call this our working cash. Then see this total use of funds. All right, I also said I want to point this out. See, please, if you are building a model and maybe the figures are more like in million, right? Because presentation for presentation's sake, those are kind of things we also consider. So most times we always prefer to, for example, I would have preferred it would be more readable to have this in so it will be more readable and easy to read for anyone, right? Looking at this, if you have it presented like this. So most time for presentation sake, we don't usually like that too much figures. So please, just to keep that in mind, that most times we usually prefer to have them maybe in 1,000 units or in million units. So it also depends as well. So always keep that in mind. Okay, so let me call up our data. So for our pre-operating expenses equal to sum, so what are the line item we are going to categorize as our pre-operating expenses? So business registration, professional fee, research and legal fee. So we are saying this marketing and expenses represent pre-operating awareness expenses. So we include that. I think insurance and rates form part of our operating expenses already. Inventory form part of our cost of sales already, right? So I think that's the only other ones that will come as part of. Let me repeat that again. So equal to sum, the line item we are going to categorize, right? Because everything must still flow through our financial statement. So business registration, those are pre-operational expenses, right? Then everything under property, plant, and equipment will go straight into our PPE. So at times you can split what goes to tangible assets, intangible assets, right? So for example, business that's more like all the software, yeah, but website can even go as part of our intangible assets. So you can split the capex as well. So that will flow into our PPE schedule. Advertising, as I said, this represents the marketing and awareness expenses before the business operation starts. If it is, also need to confirm it. This is part of what has been listed as our monthly expenses and our operating expenses. You don't need to add it because it will look like you are double counting, right? Inventory will form part of our cost of sales, raw material. Insurance, we've considered that as part of our operating expenses. Rent, we've considered that as part of our operating expenses. So the only one we are picking is everything under pre-operational expenses, business registration, professional fee, research and legal fee, then pre-operational advertising and awareness costs, marketing and PRO. So those ones will form part of this. Then our capex, I'll just sum this up as part of our capex, which is everything under property, plant, and equipment. So remember, as I said, if you can also split them into current fixed assets and what's an intangible asset. Then our working cash, I think equal to just link this straight to the working cash balance. So we always expect this to be equal to the same amount. Okay, yes. So it will not be equal to the same amount because the other one. Okay, so maybe we should just put so that it kind of balance off, right? So let's put this as part of operating. So part of operating expenses so that the total can so that it can tally, and that should be inventory, insurance, rent, right? So that should give us the same balance now. Copy that across. Okay. So please, if you have any question, please ask. Now let's create our PPE schedule. Okay. So we're going to have our beginning balance. Some people prefer to call it opening balance. So anyone you call it. Some people also call it schedule or control account. Right. So beginning balance. Some people call it balance brought forward, balance carried down. Then we are adding our capital. expenditure. Then we are deducting our depreciation. Right, and we have our ending balance. Okay. So to create our schedule layout, beginning balance will always be closing balance for previous period. My ending balance will be my beginning balance. Right, just add everything beginning balance plus additional capex, and we deduct our depreciation. I can just copy that structure across. Now for our capital expenditure, so equal to, I'll link that straight to the capital expenditure in my what? In my use of funds breakdown. Right now, let me see, did we create that? Okay, yeah, because I remember I mentioned that. Now, when it comes to business operation, because this is also very, very important, there's something we call asset turnover ratio, right? And it's basically measure how efficient the business is making use of their assets to generate revenue. And as I said, see, we are also trying to be realistic about what the normal way business operates on daily basis. Now, I'm not sure I've seen, right, and I might be wrong, where a business incur only one capex across 5 years period. Even the most mature company, they incur capital expenditure on yearly basis. Now, the capital expenditure can now vary, right? We have what we call maintainable capex. We also have what we call replaceable capex, right? So for the maintenance capex, those are just the capex, the cost you spend on keeping those assets that you have in good shape. For example, if you have an office chair, right, in your company, and you say, okay, you know what, I bought it today, I'm going to use it over 5 years. It does not mean that if anything happens to that chair in year 2, you are going to throw it away, right? It basically means that you need to be incurring some expenses, and that's why we call it maintainable maintainable capex. Those are the capex you incur in making sure that you keep those assets in their good shape. And replaceable are when you need to just buy another one completely. And in doing that, it allows the lifespan of the assets, right, to stay longer. So which means it's always good we make provision for what we call maintainable capex. So I'm going to include that in this our input worksheet, right, under our use of funds. So I'll create that here below this, and I'm going to call this our maintainable and replaceable capex. Okay, and I'm just going to, so then let me repeat the name, and I'll from year 2, right, where's our input, so I can fill this like this. So let me block this. So year 1, don't expect any maintainable capex, but from year 2, so for this one, let's even just put something like a 5,000 USD every year, because if you're using an equipment, you always need to do what, to replace it anytime. Do you have any question regarding that? I hope you understand that concept. So which means there's no way a business will incur capex in year 1 and you expect that capex to do what, to keep the business over the 5 years. No, you must always make provision for maintainable capex or replaceable capex. I hope that is clear. I hope that is clear. I hope that is clear. And another good example is this. So, for example, you have an equipment that you say, okay, you know what, this equipment will be producing 5,000 every year, right? So year one, it produce 5,000. Year two, you said the asset has depreciated. So in real sense, if you are saying it has depreciated, you expect it to produce lesser, right? Or even still maintain that production. But by the time we look at your revenue forecast, you are saying your quantity will increase. So basically, we expect you to have incurred some kind of a maintainable capex to one, either keep that asset in shape or a capex increase to increase it. So that's why it is always important to consider that what maintainable or incremental capex. So I'm going to bring that in here, right? I'm going to call that up from our input. Okay, and I'm going to add it to my capital expenditure. So which becomes my what? My initial capital expenditure plus my maintainable and replaceable capex, and I can copy that across all the year. So which means, okay, wait for now. So this is what I'm going to do. So you understand the concept, right? So let me delete this, because this is also part of what you can see in a model. So let's assume these assets will be depreciated over 5 years. So basically what we are saying is we are incurring the expenses today, but we are going to spread that, we expect to spread that expenses over next 5 years. So if I put this, just look at what's the reason why maintainable capex is also good. Now, let's look at this business-wise, right? Now, we are saying in this particular, let me just call up the quantity, our units of volume production, right? Volume sales, actual volume forecast. Yes. Now let's make use of this. Let's look at the reasonability behind this maintainable or replaceable capex. Now we are saying we have this our assets, our equipment, and it can help us produce 156. Now in year two, we are saying that same assets will produce more for us. But by the time we went to check the asset value and capacity based on the value, it decreased, right? We go back to year three, volume increased, the asset capability and volume and production wise in value has also decreased. Then by the time we get to year five, you are just telling us that this business has no assets, but was still able to produce even more than what you produced in previous year. So the story does not align. And that's where the concept of what maintainable capex come into play. Now, at times, getting a maintainable capex can be very difficult, right? Then you check mature companies' balance sheets, right? If you go and you pick their line item, you see that the asset does not depreciate as such. And that's one of the reasons why you usually have something like revaluation surplus, right? They have to revalue the assets. Oh, if you want to buy it today, how much will it cost? How much will it cost? So, which means basically what we are saying is this is not a good story because this does not align with what, because this drives the revenue. And as such, it is always good that we make provision for what? For a maintainable capex to keep our assets in shape. So basically, a good thing would have been to do what? Okay, so one, replaceable capex is to do what? So if it's depreciating at this value, Then we assume we are also making a provision for the asset to be replaced, at least to be maintained with that same amount. So if I come in here, you can see that by the end of year 5, it's saying I don't even have any equipment to produce what I'm saying. But here my story is saying that same asset is still producing even more than what it produced in year 1. So which means if I come back here and I decide to, okay, you know what, let's say, let me put this at 85. And I come back here, at least this still give like a reasonable asset value that still correspond with that our production. Okay, and this, it's easy to tell a very good story. Not that asset is just going down and you're saying production is increasing significantly, because the asset drive the what? Drive the revenue. You need those equipment to be able to make your products and sell. So please, any question? Any question? Any question? Any question? Any question? Is this clear? Is this clear before we go straight into the depreciation? Any question? Is it clear? Are we good? Any question? Any question? Anyone? My explanation is clear, right? Okay, good. Let me remove this. So now the next thing is what? Let's now calculate our depreciation. Let's calculate our depreciation now. We have what we call a waterfall depreciation, and we have what we call more like a. So we have different type of depreciation. So you can check online and see that. Times depends on the one that is applicable to what, to a company, or the one they decide to adopt. But there's one we call a waterfall depreciation, which is what we let's try and use that. So waterfall depreciation is always good for a short period assets. Okay, but most times I've realized that we tend to kind of use more depreciation rates. Most times we usually result in using depreciation rates. So what that is. So for example, if you are saying an asset lifespan, so do we have that assumptions for our asset lifespan? Okay, so maybe we might need to put this below here. Let's call this assets lifespan, right? So for our PPE, so that would be in years. And let's assume that will be, so our asset lifespan will be, let's just put it as 5 years. Okay. So if I come to my calculations, my depreciation, so because I'm saying it will be over 5 years, so to get my depreciation rates, so that will just be equal to 1 divided by what? 1 divided by my assets lifespan, and that will give me what? I think that should give us 20%. 20%. Right now, there's an option where we kind of use more like, we call it more like a reducing balancing method. So what that means is I'll come in here and type equal to, so considering this is on annual basis, that will now be my beginning balance plus my new capex, right? Beginning balance plus my new capex multiplied by what? Multiplied by my depreciation rate, so which I need to also put in. This should be in negative because we are deducting it. If I copy this across over the period, the depreciation tend to slow down. right? And just make sure we keep our asset ending balance in a realistic uh, ending balance value. Is that clear? Is that clear? Any question? Please, any question? Then the second method is where we use where we call a waterfall approach, right? So for the waterfall approach, so I'll need my period. So period one, previous period plus one. So 1, 2, 3, 4, 5. Okay. Right. And here by the side two, we're going to have so another 1, 2, 3, 4, 5. And what this is saying is, so here I will need to link each of the capex, link it here. I also use a transpose if you want to use transpose, but time just keep it simple, just link it directly. So these are our capex. Okay, so this here. So these are capex value. So basically what this is saying is for the waterfall, is saying the assets that we bought in this year. So for this one, we also need our depreciation rates. So depreciation of the assets. Okay, we need our assets lifespan. Let me just cut that up from our input, which will be 5 years. Okay, and basically this is saying asset that we bought in year one, we start its own depreciation in year one. Assets that we bought in year two. So let me invest our block format. So assets that we buy in year two, we have no depreciation in year one. Okay, assets that we buy in year three, we have no depreciation in year one and no depreciation in year two. Asset that we buy in year three, we have no depreciation in year one, two, three. And assets we buy in year four, we have no depreciation in year one, two, three, and four. Right? So by the time I want to do the calculation, just type equal to this. I can keep the rule so that I can reuse the formula, right? Divided by what? Divided by my asset lifespan. So copy that across so you can see, because we bought the asset in year one, depreciation is starting in year one. The one in year two will not start, there won't be depreciation in year one because we bought the asset in year two. So the same thing across. And this just kind of give us that kind of waterfall. So by the time we sum our depreciation together, right? So sum everything from everything above, and this just kind of give us our depreciation value for our assets, right? And if I link this back here against the first approach, this just kind of give us what the true picture kind of look like. All right, all right, all right. So let me ask you, which one would you prefer? The waterfall approach or the reducing balancing approach? So, and I think for the waterfall approach, it's also saying assets in the first period should be depreciated by should not be fully depreciated, right? We should consider half of it. For example, this period 86, saying no, because it is brand new, we should divide it by 2. Right. Okay, so saying we should divide it by 2. Yeah, they don't give the equal exactly. So as I said, this first one is a reducing balancing approach. It's a reducing balancing approach, and because of at least reducing balancing approach kind of give us a steady kind of value. That's why most times, even in our accounting, most time we tend to resort back to using this approach. So as I said, you can go online, check different depreciation uh, approach that we have, and that's one of the reasons why we should also have what we call a deferred tax asset, deferred tax liability, because tax guys are saying, this is the approach. I think tax use a particular approach, then accounting has particular approach, then the differences and the whole thing. So usually happen like that is, and then you have like a constant uh, kind of approach, right? But so most times waterfall is always the best, but because it kind of gives this huge huge capital expenditure, and remember is a non-cash expense that you've already incurred, and you are just finding a way to spread the cost over time, right? So instead of it messing, because look at, if I use this second approach, right? If you put that in here, kind of mess. Let me put this in minus. So it's definitely going to because as every year the depreciation is increasing, right? Because you're adding new assets to it. But for the reducing balance, it's just using the previous balance, right? Just making so it depends, right? It depends. There's really no right or wrong. But as I said, most times what we do, at least for our model build, most times we end up building just using the depreciation rates and use the reducing balancing method, so that more like previous ending balance as the value you have multiplied by 10%, like that. Okay, but if you are building for especially if it is company that kind of do more of replaceable assets. So they say, oh, after this asset has spent 3 years, we need to buy another one and incur another CapEx. Definitely, you are going to use method two. You are going to use. You need to just use this waterfall approach, right? But when we are considering the asset as a whole, then just don't waste much of your time. Just use your convert one divided by the asset lifespan, and just use your reducing balancing approach. But where each asset is evaluated, right, as they are coming in, then definitely you might need to use the second approach. Okay, and what you usually do is most times give us that higher value, right? Okay, so just so that you know that this exists, we have this approach one, we have this approach two, right? And also even they're like equal, right? I think this waterfall is more of also equal depreciation value, so you can see for assets that we bought in year one, they're just the same value. The one we bought in year two, maintain the same value, like that. All right. All right. So for this our own, I'm going to keep the depreciation rates, the reducing balancing method, right? The waterfall, I think is that's the straight line method. But as I said, over time I've realized that most times for our model build, we kind of prefer to make use of this approach. All right. So after that, next thing I need to do is to link that to my financial statements, my model. So my EBITDA, my depreciation in my income statement equal to minus. Okay, I don't need to put minus because it's coming as negative from our calculations. So link that. Okay. Then my model is showing error. Go to my assets, link this to my ending balance in my balance sheet, and go to my capex and link that to my what? To my PPE capex. So it should be in negative because it is taking cash out of the business, right? And back my bullet. So I think this one we don't have intangible and the other line item. And then my balance sheet is balanced. All right. All right. All right. All right. So now, which will be your own activity against next session. So your own activity now is to build out the funding part, right? I know I have some videos on my YouTube channel. You can look through some of them where uh, we've built this kind of a thing, right? And look at how we build out the equity and the debt. So which will be your own assignments, your own task against our next session. So please remember, this is part of your own self-learning, self-development, right? And that's the best way you can learn. Sit down at it, try, make mistake, don't worry, it's part of the learning process. So make mistake, try to see why this, why that, ask different question, right? And you know how we do it. You submit your version, then I share my version with you, which you can use to update your own as needed. So please remember, build out your own asset schedule, then go ahead and build your funding uh, schedule, or if you prefer to call it control accounts, right? For equity and for the loan. And then I will share the recording with us after the session. So please remember to complete your task against next session. So let's call it a session here today. If you have any question, clarification, before we call it a session, I'll just give us some few minutes to address that. All right, so thank you everyone, and let's make sure we enjoy the rest of the day. I will share the recording with us immediately. We have that available. So why did I delete the right of? Yeah, because we don't have those line item. It's not applicable. But cases where you are building your model and they have intangible assets, then definitely know that you need that. It is not applicable in our case study. All right, so thank you everyone. And please do enjoy the rest of your weekend and be good. So bye for now.
Sorry, I have a question, sir. I can't type it, obviously. Can I ask you, sir?
All right, please.
Okay, so based on the depreciation, the waterfall depreciation, we can look at the end, like from maybe year 4 to year 5, it increases. So me, I'm thinking based on depreciation is a non-cash expense and we reduce the, uh, I think, taxes that we pay. Do companies really consider that?
Sorry, say that again.
So I said, like, based on the waterfall depreciation, we could see that at the end of it, like it increases. Like the numbers are big numbers. So I'm saying, like, because depreciation is a non-cash expense and it reduces definitely our the taxes that we pay. Do companies consider these like due to the fact that we pay lower taxes if we have a higher depreciation?
So, as I stated, that's one of the reasons why we usually have what we call deferred tax assets and deferred tax liabilities, right? And it's just because of recognition of depreciation at different periods. So I think for tax has what we call capital allowance that's being used. So even irrespective of your own the approach you've used, right, is just because you're only delaying the expenses. So thing about capex is you bought something for 43,000 in year zero, more as let's say in year one, right? You've accounted for it in your cash flow as this same value. Okay. Now, because for income statements, all expense, all costs, as long as it's a cost, must also flow through your income statement. Now, what will happen is if you decide to put all these costs, right? If you decide to put all these 43 million in our P and L, you know what will happen? It's going to reduce our profitability by this 43 million. So by a negative of 43 million, right? But now, because we expect these assets to be used over a particular period of time, even though we've paid for it today, but it still need to flow through our income statement. That's why we now say, okay, you know what? Let's find a way to spread this across. So we're now saying, okay, you know what? Let's spread this over a 5 years period. So it's not as if it's not as if it is not a non-cash thing. But because we've incurred it, and we're saying, oh, this asset is an huge capex thing and it's something we expect to use over a long period of time. So you know what we do? Let's spread it across this particular 5 years. Right? So let's say an accountant is saying, okay, you know what, this is what we are going to spread it over this particular period. Right? Now, but for tax we now say, oh, okay, this is what you've done. We don't have any agreement around that. Tax will now tell you that, okay, you know what? Firstly, maybe you need to recognize 50% of it in year one, right? And then the other one, you represent it with, let's say maybe 20, so 20% of it over maybe the next 5 or okay, so this will now be equal to this value, right? You minus this guy from it, minus the first initial recognition of it. I think this multiplied by 20%, right? Then you spread it across. So now by the time you sum these two of them together, they're still going to give you this same 43 million, right? I think I think it's even 25. So if it is 25, then by the end of this year, so which means for tax, this is the way taxes as recognize their own capital allowance. So I think in tax we don't call it depreciation. I think we call it capital allowance, right? My tax experts guys, please, the chartered accountant want. So which means this just becomes a what? A recognition differences. So by the time your accountant, you prepare your own reports, you get your profit before tax, right? What tax guys will do is they will now pick that your profit before tax, they will add back the way you've calculated your own depreciation, and they will now calculate their own proper using their own capital allowance approach, right? And that's where the difference come into play, right? So because you are recognizing it this period, then it goes off in their home book quicker than your own. So it's not as much as we're saying is a non-expense, it's still a cash expense line item. Just that because we've recognized it in year one in our cash flow, that's why we are adding it back. So that's just the differences. So even if you decide that, you know what, we are going with the second approach, because the next assets comes in, it also starts its own lifespan like this, like the first one, right? But you know, because of our own model build, right? Though typically, I think if there's this, if we don't have this maintainable capex, right, you kind of expect this to be fully depreciated over 5. So reducing balance most times also give you the same results, right, over the period. So I hope that answer your question.
Oh yes, thank you. I understand. Thank you
Okay,
so
yeah,
much.
right, yeah. All right, so thank you everyone. Let's make sure. Okay, yeah, so there's an item from the information that's not included in a previous investment in the business of 5,000. Oh, very good. Yeah, that's a very good one. Uh, so most times when you have things like that, what usually happens is either you recognize that's 5,000 cost they've incurred as part of the equity contribution, right? And you also add it to the assets element so that it can balance each other off, right? So maybe somewhere you can just add the line item for pre-operational investments, then you add it to the equity schedule, then you also have that same value back to part of the PPE schedule. So that I think maybe next session we can take a look at that. All right. So thank you everyone. Let's enjoy the rest of the weekend. I will see you in the next session. Thank you. Bye for now.